The home equity access scheme is the best kept secret in Australian investing. Investors who are 67 years or older can borrow money from the federal government against the equity in their home at very low interest rates. Australian households who own their own home can expect to increase their wealth by between $200,000 and $1.2 million if they use the home equity access scheme fully throughout their retirement. Now, I know that doesn't sound right, but it is right. And I'll show you how it works in a set of examples in this video. Let's start off with an example of a wealthy couple, Beck and David, and then move to examples of investors who have less money. Here they are. They're 67 years old. This photo was taken a few years ago, and they're Australian citizens. Now, that means that they're eligible to receive the age pension. They won't actually get the pension because they've got too many assets outside the ownership of their home. But being eligible for the pension is the first criteria for being eligible for the home equity access scheme. Now, in addition, they need to own their own home or other property, and they need to have at least $20,000 of equity in that property. If they meet these criteria, then they're eligible to use the home equity access scheme. Now, they've got assets of $1.5 million outside of their home. That money's in their super, and that's more than the maximum of the asset test, so they're not going to receive any pension. But that doesn't mean they can't use the home equity access scheme. There's a misconception about this that's stopping people from using the HEAS scheme. A lot of people think that you have to receive the age pension in order to access the home equity access scheme. That is completely wrong. You only need to meet the criteria of age, 67 years, citizenship, being a citizen or a permanent resident, and ownership of property and enough equity in that property. And then you can use the home equity access scheme. So let's put the notion that you have to receive the age pension to use the home equity access scheme aside. So how much can you borrow in the home equity access scheme per year? Well, up to 150% of the age pension. For a single person, the age pension is $28,500 per year, and for a couple, it's $43,000 per year. But how much you actually receive depends upon the asset test and also the income test, but it's the asset test that's important for us here. If you have assets less than $450,000 outside the ownership of your home, then you receive the full pension. And if you have more than $1 million, then you don't receive any pension. If you have something in between, then you receive a pro rata pension. If you had $670,000, then you receive 60% of the pension. Now, you can borrow in the home equity access scheme up to 150% of the age pension, which is $64,500 for a couple, minus the amount of pension that you receive. So in this example, 60% pension, that couple could borrow up to 90% of the age pension, the difference between 150 and what they're receiving in the pension. But of course, Beck and David are not receiving any pension because of their high assets outside the ownership of their home. So they could borrow the full 150% of the age pension. So that's on an annual basis. But how much could they borrow over the course of their retirement? Well, let's have a look. Let's imagine that they start borrowing when they're 67 and they continue borrowing until they're 90 years old over these 23 years. And up here, we're going to have millions of dollars. And the first thing to know is the value of their home. So in this example, the value of their home is $1.7 million, which is growing at 4% per year. So I'm assuming that it's growing with inflation, and the pension grows with inflation as well, and inflation is 2.5%. And then there's real growth of 1.5%. Now that's a fairly modest assumption because the real growth in house prices in Australia since 1970, over those 53 years, is nearly 3% per year. So here we're assuming 1.5%, a modest assumption. Okay, that's the home value. The second thing is, in determining the maximum loan amount, is what percentage of the home value you can borrow in total. Now that begins at 27.4% at the age of 67, but it rises quickly as you get older until at the age of 90, it's 67.5%. So the maximum loan amount is growing quickly because the value of the house is growing and the percentage of the house that can be borrowed is growing quickly as well. So what we can see here is the accumulating principal, $64,500 in the first year, and then that amount grown by the inflation rate in the second year, and then add the third year, the fourth year, the fifth year. This is the growing principal. And then on top of that, there is the ballooning interest payments. So interest isn't paid on these home equity access scheme loans until the house is sold, and it balloons over that time at the interest rate of 3.95%. Now we can see here that in the 11th year, we're going to exceed, in our example, the maximum loan amount. So beyond the 11th year, beyond the 78 years, they won't be able to borrow the maximum amount. They can't go above, in the total loan, this green line, which is the percentage of the value of their home. So let's take another example where the value of their home is a bit higher, 2.2 million, and we'll see then that they're unconstrained. So here we have it, the 2.2 million, again growing at 4%. Down here we have the maximum loan amount, which will be higher because the value of the house is higher. And then we can see here that the principal and the interest is fitting underneath the maximum loan amount. So in this example, they're unconstrained. Most people, when they hear about the home equity access scheme for the first time, have two instinctive reactions. One is, the money in my home is for my children. I want to leave that money to my kids. And the second one is, I need a rainy day fund. What if I run out of money? I'm going to need money for aged care. I might need money for a medical emergency, etc. Now, I would say those are both legitimate concerns, and I sympathise with them. But you don't have to spend the money. You can borrow the money from the federal government under the Home Equity Access Scheme and then invest it. And then you'll have more money to leave to your children. And you'll have a bigger rainy day fund. So let's look at the example with Beck and David, where instead of them getting the money from the Home Equity Access Scheme and spending it, they get it and then they invest it. So here they are. They're going to invest the Home Equity Access Scheme proceeds. And up to the age of 75, they're going to make contributions to their super. After the age of 75, they can't do that. And then beyond the age of 75, they're either going to gift or loan the money to their family trust. Now, they're going to borrow 150% of the age pension each year, and they've got a house worth 2.2 million, so we don't expect them to ever exceed the maximum loan amount. Okay, now let's look across the years from them being 67 to them being 90, here on the x-axis, and on the y-axis, millions of dollars, how much their investment is going to grow to. So it's going to grow to a very large amount. And what we're assuming here is that it's growing at 8% per year. They're borrowing $64,500 in the first year and then investing it, and it's growing at 8%. And then the next year to 2.5% more than the $64,500 because we expect the pension to grow at the expected inflation rate of 2.5% per year. So then the total amount that they've borrowed over both years growing at 8% and then borrowing more in the third year and it growing year by year at 8%. This is inflation plus 5.5%. Can we expect to get 8% on an after-tax basis? Well, certainly in super. Could they do that in their family trust? Well, let's come back to that in just a moment. But this is compounding at 8.5%. What about the debt? Well, that's compounding at 3.95%, which is the interest rate on the home equity access scheme. And of course, their investments are growing at 8%. The debt is compounding at 4%. And so the difference here is the amount of wealth that they have created for themselves by participating in the home equity access scheme. These are the expected values. Now, it's a really very large amount. So making super contributions until the age of 75 and then making either gifts or loans to their family trust after the age of 70. So the debt's going to grow to 3.2 million. Their investment's going to grow to 5.3 million in super and their family trust. And the difference here, 2.1 million, that's a massive amount. If we bring that back to today's dollars by discounting the expected inflation rate of 2.5%, then that's $1.2 million. That's the expected amount of extra wealth that Beck and David can create for themselves by maximizing the opportunity that the home equity access scheme represents. You can see why I refer to the home equity access scheme as being the best kept secret in finance, the lowest hanging fruit for investors. Now, what about the 8%? Is it realistic to assume that they could get 8% after tax? Well, yes, in super, because there is no tax in super, and the good super funds have earned a lot more than 8% over long periods of time. What about in their family trust? Well, there's a couple of things to consider here. One is that the interest payments on the loan are going to be a tax deduction against the income from the assets in the family trust, so that'll reduce the amount of tax. And then the second thing is that they don't need to realise capital gains. So their total return is going to be the sum of income from the assets and the capital gains on the assets. They don't need to realise the capital gains in the family trust because the disposal of the house at the age of 90 in this example is going to pay off the loan, the home equity access scheme loan, by itself. So they're borrowing the money against their house. The house is worth more than the home equity access scheme. So they'll be able to, when they sell the house, they're going to be able to pay off the home equity access scheme and have an additional amount of money. And there's no need to dispose of the assets in the family trust. So there's no realisation of capital gains. So in this example, the 1.2 million expected increase in wealth, which comes from the assumption that the investments are compounding at 8% versus the 4% compounding for the loan. That's the source of the value as well as the size of the amount of money that they're able to borrow. It's a realistic assumption. Now, there's some things here that you don't understand in this discussion, in particular what I'm saying about family trusts and about super contributions, then perhaps you should take my Finance Equity for Investors course. Next course is coming up on the 2nd of May, 2024. And it's running over 10 Thursday evenings for 2 hours. And then we have question time after the 2 hours. So 10 Thursday evenings, you can watch the courses live. They're on the Zoom meetings. It's online. And then you can watch the classes video on demand, all of the content in the classes. Now, there's additional content beyond the classes that's also available on demand to flesh out your total understanding. There's lots of materials. The purpose of the course is empowerment and getting to better outcomes. Empowerment meaning that it gives you the feeling that you fully understand all of the opportunities in investing, that feeling that there's big things going on that you don't know about, that goes away. The feeling you don't know who to trust, the feeling that you can't get traction in your investing, all of that will go away in the taking of the course. And then getting the better outcomes, of course, means reaching your financial goals more quickly. The course is $1,200 plus GST per household, meaning that everyone in the household can watch the course with the subscription. And it processes week by week through increasing your knowledge, developing an investment process for you, and a guided self-examination of your investing, where I give you the structured opportunity to work out what's right and what's wrong about your investing and to fix what's wrong. So about 2,000 people have taken the course and really had a fantastic experience with it. If you want to learn more about the course or enroll in the course, then please go to wendellstone.com.au. So what if Beck and David had less money outside the ownership of their home, so they were receiving a part or even a full pension? Would it still work for them to borrow the money with the Home Equity Access Scheme and to invest it? Would they even want to use the Home Equity Access Scheme? Well, let's look at a couple of examples. So here they are, 67 years old, Australian citizens, 2.2 million, home in value, 670,000 outside the ownership of their home in superannuation. So that puts them here, 40% of the way from here to here, from 100% pension to no pension, 40% of the way. So they've lost 40% of the pension. So they're receiving 60% of the pension. Now they can borrow up to 150% of the pension minus what they are receiving. So they can borrow through the Home Equity Access Scheme up to 90% of the pension. So let's have a look at whether that's going to work for them. Here are their assets outside of the family home. Here's the pension that they're receiving. So I'm just repeating a lot of the information we saw in the previous slide. So up to $450,000 of assets outside of the family home, they receive the full pension. And then if they have assets of more than $1 million, which was the previous example, then they don't receive any pension. And in between those two amounts, $450,000 and $1 million, as we saw in the previous slide, the pension they receive is going down. So for every extra $1,000 of assets they have outside the ownership of their family home, under the assets test, they're losing $78 per year. So this is really quite punitive in this zone, how quickly people's pensions fall if they have extra assets. And this really dominates the income test, and that's why we've left the income test out here. So let's consider these different zones. Let's look at this zone to begin with. If they had assets of less than $450,000 outside of the family home, then they could borrow up to 50% of the pension and invest the money. And if they invested the money, then their gain would be the 8% return on the investment minus how much it cost them to get the money, the 4%, 3.95% on the Home Equity Access Scheme. So they would gain a lot, expect to gain a lot, and not lose anything. They wouldn't lose any pension from borrowing the money if they were in here. Now, what about if they're out here, which was the previous example? Then they could borrow 150% of the pension because they're not receiving any pension. And the gain would be the same. The difference between the return on their investments minus the cost of capital to borrow the money against the house through the Home Equity Access Scheme. And there'd be no loss because borrowing that money and putting it into their super, into their family trust won't reduce their pension because they're not getting any pension. So both of these are good. And really, this is just a scaled down version of that. So we might expect that in the previous example where we saw that they could expect to increase their wealth by 1.2 million by enacting the strategy of borrowing against the house through the Home Equity Access Scheme and investing it in their super and then in their family trust, then they could expect to make 1.2 million. Well, a scaled down version of this over here is what they might expect to be able to enact. Now, there will be the issue of them going into this zone, and I'm coming to that in just a second. Here we are. So in this zone, you don't want to borrow because the gain versus loss is a different equation. Now the gain is the difference between the return on the assets and the cost of borrowing, return on the investment and the cost of borrowing. But there's a big loss. If they borrow money and invest it, then it's going to reduce their pension by a lot. And so they'll gain the 4%, but they'll effectively lose 7.8%. Every $1,000 of extra assets outside the family home, they're going to lose $78 per year. So they're effectively losing 7.8% by borrowing the money and putting it into investments, and they're gaining 4%. So this is just a losing proposition to use a home equity access scheme for investment purposes, not if they want to use it for consumption purposes, but for investment purposes, that isn't going to work. You know, they're really in the dead zone in here. This is so punitive. You can see why people want to get out of this zone. Why it's not uncommon for people to take money out of their super and to renovate their home or even buy another home or just spend the money to get down to here. We'll talk about that and the asset test in more detail and income test in another video. To bring out a few more important points, let's look at the pros and cons of the home equity access scheme. And I'm thinking here in particular of using the proceeds of borrowing the money to invest. So let's start with the pros. Large amounts, so $64,500 for couples who are not receiving the pension. Low interest rate, borrowing large amounts at low interest rate. No wonder there's so much value in this. And then no margin calls. This is a really important point. So borrowing to invest, which is what's going on here in our examples, is terrific because instead of growing your investments at this rate, you can grow it at this rate. You're borrowing at a low interest rate and investing at a higher return and creating value, and your wealth grows more quickly into the future. But borrowing to invest amplifies risk, and it does something else. It introduces the possibility that you'll be forced out of your investment at the bottom of the market. So for instance, if you were to borrow from a broker to invest in shares and the market's going along nicely, and then suddenly the market tanks, such as it did in COVID-19 or in the global financial crisis, the market goes down, later fully recovers and more. At the bottom point of the market, it'd be very common for the lender, the broker in this example, to say, we want our money back. And so you would be forced to liquidate your investment and be forced out of your position at the bottom of the market. So people who borrow to invest need to be very careful and think ahead to make sure that that doesn't happen to them, because that's happened to thousands of investors, especially in COVID and especially in the global financial crisis. Now that can't happen here because the government is never going to ask for the money back before the sale of the house. They make an absolute promise about that. So no margin calls, no getting forced out of your position at the bottom of the market, which gives you much more capacity to ride through downturns in the market, which is a very important thing. No margin calls, don't underestimate the importance of that. And then also a negative equity guarantee, which is the federal government saying that no matter what happens to the value of your house, that will cover the loan. You'll never be asked to put extra money in. A guarantee that even if your equity in the house went negative, then the house itself, the sale of the house itself is enough to discharge the loan. That also is important. I mean, these are tremendous things. What more could you want? Borrow large amounts at a low interest rate with no margin calls and with a negative equity guarantee. Now, what could go wrong? Well, interest rates could rise. And this is up to the relevant minister in the federal government. So they could raise interest rates. Now, to get around that possibility or to mitigate that risk, it's a good idea it would be a good idea to invest the proceeds from the loans in liquid assets. So you could unwind your position if you had to. Another issue, of course, is that it can affect the borrowing of the money can affect the asset test, and we saw that already. So I hope you've enjoyed this video. Thank you for getting all the way to the end of it. Let me ask you to like the video and to subscribe to this channel. And don't forget about my Finance Education for Investors course. Please go to windlestone.com.au for more information on the course or to enroll in the course, which starts on the 2nd of May, 2024.